As you know, the market has been in a bit of an upward, we've been in an upswing for the last week or so, and we got to some interesting levels that I discussed in the weekend review video. I had said that we would first start getting into the breakdown level, really at 197.86, but I thought that there was some room up to the 199.96, which was the 61.8. So that turned out to be correct. That's also roughly the 100 M. I said 199.96 to 200. We basically got there today. We actually had an overshoot through it. That is a very important confluence of technical levels. I will show this in much more detail on the weekend review video. However, I can say it is the 100 MA, the 61.8% Fibonacci retracement from the peak on 11.3 to the low of 120, although we had basically a double bottom there at 120 and 211. And it's also, more importantly, the downtrend line from that leg. We did close above there, which it's very hard to argue and say it's not bullish. It is. It is a close above a downtrend line. However, the context is, and there is some potential move still higher, believe it or not. The 201.90 and the 200 MA are almost coinciding around, that's around 202.42. There's a big gap fill that's still above us. I saw some people talking about that today on the stream, which is 203.87. These things are all possible to the upside. And there was a tweet I put out today that said, it's not as important to know or to buy or sell the exact high or low, but to do it at the right time. Meaning that you're never going to know the exact top or the exact bottom. And it's very hard, I'll tell you that many people have lost fortunes trying to pick the exact tops and the exact bottoms and moves. But if you sell it roughly or buy it roughly the right time, within, a few percent, you'll probably be more happy than not. I'll tell you, I've had instances where I've sold a stock a little bit too early. It's run up a couple of dollars, and I missed out on that, but I saved myself the tens of dollars when the thing collapsed. Because my calculations had taken, sometimes it overshoots my calculations a little. Like, let's take Facebook, for example. Let's pull that up. I had said I thought we were going to get the 116.07, which was the 1.618 Fibonacci extension. I talked about unloading some there. It actually got 117.59. So if you sold at 116 and you missed out on the 117.59, you missed that dollar and change. Yeah, it sucks, but guess what? You also missed a huge decline. The stock basically nosedived from there down to the 96s after that. Yeah, we're getting back up to the 110s where I said we should start to unload again. I had been short some puts from the 99s and actually a little bit below 99s, and believe it or not, they had more DTE. They were a little bit longer dated. I have some reasons why I did that. I usually talk about selling more near-dated options, but in this instance, I did a little bit longer dated. And I'll tell you from past experience, and I tweeted this out, that when you reach your target strike of the stock, even if you have a lot more multi-days to go and there's more premium to erode, you want to take it off. I'll tell you, I've learned the hard way, and I like to share with you guys some stuff that, to help you guys avoid learning the hard way. When you have multiple days to go and you want to try to get all of the premium from short put sales, it's not always, it works out if it's very short dated sometimes. Even then, believe it or not, I still take it off. But if you have a lot of time to go and you get the move you're looking for, don't be a pig. I promise you that there will be a couple of times where it goes to zero, but the times that it doesn't, that it reverses, will more than make up. Those losses will more than make up for the instances that you don't take it off. So that's my 2 cents on that. with regard to, let's flip back to S&P land here. So like I said, it's very possible there are still some more upside targets, but we have now started to reach some very significant ones. We did overshoot today. We've been in a really large short squeeze. I'll tell you what I think has caused this is the people who played in 2013 basically were very well rewarded in what really was an abnormal market. You know, everyone, I think, got trained to think that 2013, for whatever reason, is the norm. Just like 2008 and 9 were not normal, 2013 was not normal. We've been in a period of really strange times, as they say. So you basically, over time, it's been presented by a lot of finance and statisticians that over time the return of the stock market is roughly 10% a year, average. So I don't necessarily agree with that, although that, believe it or not, that's what was taught to us in business school. For those of you who don't know, I went to a very fancy business school. I went to NYU Stern Business. This is what was taught. But in 2013, the market was up about 30%. That's about 3 years' worth of gains. We are now roughly where we were 3 years ago. So 3 years' worth of gains and 3 years' worth of time to wear it off, basically to consolidate. So that's why the last three years have basically been consolidation periods of time, working off that excess. So that has been very frustrating. I've been, for a lot of traders, I've been getting, I'll tell you, I went through my emails, even today, and my DMs today. I have a few that I have to respond to, so if you're watching this, don't worry, I didn't have a chance today. I assure you I'll respond to you. But the common theme, and it's not one person, this is like dozens of emails, people are struggling to be profitable. They're having a hard time either in their retirement accounts. I got a few emails about people's retirement accounts. I got some questions about trading accounts, and I'll tell you my advice. Basically, they've been getting whipsawed. People are getting whipsawed in this market because what the strategy that worked in 2013 was to buy and buy and buy no matter what. Any dip was buyable because the market was in an up trajectory. We are not in an up trajectory anymore. We are on this leg of this market, but we are in a sideways consolidating market, and the down moves are very, very real. So what I think people are doing is they're trying to say that, okay, the market is topped out, and they're using the same strategy that worked for them on the upside to the downside, meaning shorting, 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 no matter what, because they figure the next price will always be lower than the next. It doesn't really work like that. You know, I've hypothesized why the market has been staying stubbornly strong for a while. I've talked to you guys about the interest rates, about how we have very low, still historical interest rates, and that is keeping a PE multiple premium into the market. I still believe that's the case. I will discuss that way more thoroughly in the weekend review. But this is what's happening. People are getting short at the wrong time. They're basically getting short on down days, hoping for still further down days, and they're getting whipsawed when they are basically short at bad prices, and then they don't get follow through still lower. They get squeezed, and the market goes up, and they panic, and they cover basically on up days. So they sell it on down days or down weeks, and then get panicked out with what happens when the market goes up. Basically, the market is getting overly short at bad prices. So where does that leave us? We have in place now a basically quadruple bottom. If I will say this, that if the recent lows that we had from early February get taken out, the market is going, I believe, will be an absolute free fall. We are a long way from there. It is also, believe it or not, still possible that we could make a run for the old all-time highs and maybe even finally, absolutely finally, get the blow-off top where we go completely parabolic vertical and there is some type of a blow-off in the market. That could set up for a multi-year short that could be the trade of a lifetime. I think that's sort of every trader's dream, right? To catch the exact bottom and ride it, for years and years, or to sell the exact top and be able to ride that for years and years. It's really hard to do. I know it sounds easy, and in retrospect, when you see the charts, oh yeah, I see it, I would have done it this way and that way. When it's real time, it's not so easy. And You know, short covering rallies when you have bad location, even if you have good location, are it's very challenging, you know. It's hard to see a market rally, you know, this type with a move like this, you know, when you get back down to the 180, you know, 181s, it looks like the end of the world. It looks like the market's going to snap, and you know, today we were trading at 201s again, believe it or not. I mean, that's basically a 20 handle move in SPY. That's a really big deal. We basically took back a lot of the dump. I mean, we're basically back to where we were before the dump, and that is why we are now we are late in the rally. Where round, you know, they say round she goes, where she stops nobody knows. But I would venture to say that we're within a few percent of a point where we may have a short-term peak and a pullback. And the bad news for that will be that it's basically we're at where the overhead supply was, and it's a still lower high off of an equal low here. It's not really a lower low, but an equal low with a lower high, and that's going to get all the technicians really nervous in the next couple of weeks, is my guess. So we have a narrow window here I mean, like I said, we can still go a little bit higher. I think there's room. It's the risk. I always think when I think about putting on a trade, what my risk versus reward is. If I'm betting $1, so to speak, how many dollars am I going to get back in return? Am I going to get $1 back in return? Is it a 1-for-1 bet? Am I going to get $2 back? Am I going to get $3 back? I usually like to say if I'm risking $1, I like to get $3 back in return. Sometimes I'll take it if I'm really, really sure on it, if it's at least 1-for-2. I don't do 1-for-1. And right now, I really honestly believe that we're getting very, very close to that 1-for-1 type of a situation. At least short term, we're really extended. The 20 MA is down at 192. The 50 MA is really basically down at we're in the 193s. I mean, and that's, believe it or not, first turning. It's like first flattening to turn positive. And you have a 200 MA overhead today, in the 202s. So yeah, we technically did break a downtrend that is bullish. I don't want to say it's not, but we did. How we got there, we did it in a very, very sharp fashion. So that's my 2 cents. That into rallies from now on, if there's like, let's say Monday is a gap up or whatever, you're probably, particularly if it's a gap up to the 200, right to the 200, that is an amazing right or right out short situation, and I would take that in size with a stop above, preferably it's RTH. It won't happen pre-market. The best situation, honestly, for that would be is there's a gap up on Monday, the high in the pre-market is higher than where the open is, and then the opening 15-minute range doesn't, like there's an attempt at a rally, the opening 15 or hour or whatever, that peaks lower than the pre-market high, and then you short below the low of that opening bar, and you should have yourself a pretty nice little runner. If that, and then with, of course, a stop above that opening range. That, to me, would be an amazing short setup, particularly if it's right to the 200-day moving average, considering we've had so many days up. It's not saying that that's going to be the peak of the market and that we're never going to see these levels again, although, believe it or not, if this is the peak, it very well could be. But that, to me, is a great day trading setup. Maybe I'll detail that a little bit more in the weekend review video. I'm assuming that's something you guys would be interested in. And I'll show what that looks like a little bit more graphically so that, when it's happening in real time, you'll know what to look for and you'll know what to see. It's the same thing with a low. I'll give you that example just quickly here. If you have a gap down pre-market and then regular trading hours, the open is higher than that low, and then there's an attempt at a push lower, but the low isn't lower than the pre-market, then you take out that opening range high. That is a long trade just as well. Usually you want to look for those more at the bottom of a range than at the top, clearly. It reverses at the top. But when stocks rally, the risks rewards start getting less and less. Like today and yesterday, I was talking about really selling positions, and I'll tell you today, I was lightening up a lot of stuff. I had tweeted it out. I don't want to get too redundant about the positions that I closed. Believe it or not, there were even more that I didn't talk about. But when a risk reward starts getting, when we start getting into areas where there was past support and that could become that is what becomes resistance, particularly where there was a breakdown, and that's really what I think happened today with the S&P. I need to look a little bit more where we, with regard to SPY, where we broke down from, where we peaked from. It was starting. We got into one of the bodies, but we were starting to get into, like I said, the real breakdown, the breakdown zone, the hammer lows, and I'll detail what that means in the video. I know a lot of people don't always know that technically. We're basically in the 199s, the high 199s, and we squeezed a little bit above there. So this is sort of now, honestly, a guessing game about where we top before we have a pullback. And my guess is that we're either there now or we're within a few percent of there. So, like I said, I would. What is driving the negativity? Pure technicals all year. I'll talk about that in one sec. Let me just finish this. This thought. So I think that, like I said, the risk reward rallies now I would be looking to lighten up into. If you want to reload your longs, do it, I would say, on a pullback, and I'll discuss that, if and when it happens. So someone just asked, why has there been negativity all year? What has been driving it? So what's been driving it is the macro economy, and this is you actually are flowing me into where I wanted to really begin. Usually I begin these videos with talking about the more macro outlook. This got into the technicals right away, so let's just back up and let's talk about the why. How's that? The technicals are really what is important, believe it or not, because the why is somewhat open to interpretation, but my interpretation is going to be the correct one. So let me tell you why this is happening. The Fed, as we know, hiked interest rates. I think by anyone's measure at this point, they realized that that was a policy mistake. I know that it was hotly debated with me on Twitter, but I think even those people at this point realize it was a mistake. You don't hike interest rates into a slowing economy. Interest rate hikes are to cool massive amounts of speculation or to cool a overheating economy, and the economy is clearly not overheating. We are at best a 2% growth economy, and at worst we are in either stall speed or even dipping our toes into negative growth. Part of the reason for the decline has been the economic indicators have been slowing. I've posed to you that and we had a jobs number today, that the jobs numbers have been suspect at best. I will review today's specifically in one moment, but they have been a lot of part-time work. A lot of that is as a result of Obamacare. Companies are not hiring workers full-time, and they are part-timing them to avoid having to pay the tax, the Obamacare tax. It's been a lot of waiters, waitresses. I joke around with carnival ride operators, but that, believe it or not, happened. That was a thing this summer. So it's not high quality jobs, and that was really into today's number specifically. And I wrote down a little bit of notes. We had some revisions into the last 2 months, which is good. They were up about 30,000, so the revisions were good. They were in the right direction. The unemployment rate is, they were saying about 4.9%. I've detailed in past videos that is very misleading. If I had to give my best guesstimate, we are probably in the lower to mid-teens. When you factor in people who are working part-time, who want full-time work, people who are underpaid in jobs where they would normally be making more, and people who have given up looking for the labor force. That number, I can tell you, could be hotly debated. I assure you that it is correct. I have a lot of experience with this type of stuff, measuring. You've seen, I've discussed very accurately my take on the economy and on numbers, and that is really my take. I really do believe it is in the low to mid-teens. I would say it's probably more the lower teens than the mid, but it's possible that it is up there. The labor force participation rate, that number got a little bit better. That basically just means that the percentage of Americans working is probably, or I shouldn't say probably, is the lowest rate since like 1977, 1978. That participation rate got a little bit better. I won't say that all of it is a result of the economy. As a whole, birth rates are getting are lower than they were in previous generations. People are, just because of the way modern life is, and I guess because the economy is crappy, people are, they're a lot of people in my generation who are at their kind of their peak earning capacity, so to speak, are either getting underpaid, have been out of work. I can't even tell you how many of my friends have moved out of New York because they just simply couldn't afford it anymore. Or in the crash in '09, this really happened, a lot of it in 2011. But there are still some remnants of it. I still have some friends of mine who are really struggling because of the economy. And I think that that has led people to put off having families or children till later, and that has led to a lower birth rate, and the existing, this is really what happened in Japan, the existing population is getting older, it's graying. And as those people retire, the percentage of the labor or the percentage of the population who are participating in labor is lower. So it's a combination of that, the graying of America, and also the crappy economy, really. So that's really why the labor participation rate isn't great. Hourly wages were not really good. They went down a little bit. That means the amount that people are being paid, so it's not that good. What the Fed really starts worrying about with inflation is when wages start really spiking, and that is not the case here. So this was a little bit of a Goldilocks number. I'll talk about what I mean by that in a moment. Average hours worked was down. That means people are working less. That's not good. And productivity is down. That's not good. That means the jobs aren't that great. The quality of the jobs aren't that good. So why did I say this was a Goldilocks number? We also, by the way, and I'm going to tie this in, we had ISM readings this week. The service number was not good. So that means that the service economy is still weak. However, why is this Goldilocks scenario? The economic numbers that were reported this week, some of them were a little bit recessionary, and some of them were on the decline. They were clearly in decline. The good news is that the rate of change, that means the amount that the change has been happening from number to number, and from 2 numbers ago to this number, and from this number, or from the previous to this, the rate is slowing, meaning that the speed we're declining isn't as fast as it was in the last reading. That is good. It means that the decline in the economy is not gaining speed, it's slowing. I would say that the numbers that we got this week mean that the chances of a first half recession are low to none now. We were in a lot of danger to having, I believe, a full-on blown recession in the first half of the year. And while we are still weak and we are stall speed, the chances of that happening to me are greatly, greatly diminished. However, the risk is still that we have a weak economy, and we could go into that, have that scenario happen in the second half of the year, meaning the Fed needs to be on hold. So we have conditions that are less bad and a Fed on hold. The percentage of a Fed rate hike yesterday was about 6%. I know there's a lot of talk on TV that they're back on the table, but I believe I looked today, it was like 0%. And the only time you really started getting a significant number was June, July for those meetings, and that was like still 25 to 28%, meaning over 70% and 72 to 75% probability that there is no hike this year, at least through the summer. I have to take a look at what it is for the later part. My guess is that number gets still higher in December, but the probability of a Fed rate hike is pretty low. I had posted the link to that. If you go through my Twitter stream today, I posted the link to the Fed probability, and you just go through there and you can see where it is in any given period of time. So that to me is what Fed has been feeding this rally. We now know the results of it, that the rate of change for the slowing of the economy is slowing, and that's really, if you want to start getting into derivatives for people who are options people, the absolute change is your delta, and then the rate of change is your gamma. So basically our gamma is contracting here in terms of the slowing in the economy. I hate to say the good news here, but the news that is important to the Fed is the fact that we are still slowing, that not so much the rate. So that's going to keep them on hold, because that rate of change, just because it's slowing now, doesn't mean that the next reading isn't going to pick up again. It could start declining, even faster. Sorry, I don't get commercial breaks, so I need to take a little bit of water here. So that, I think, is really what's going on here, and why we've had this kind of reprieve, this rally. It's been on the fact that the chances of a recession here are, frankly, greatly diminished. Like I said, though, the bad news, though, is that the technicals are starting to get a little bit stretched. Like Brazil, I think, was up 25% this week alone. That's not a stock, that's an entire market. Imagine if the U.S. stock market was up 25% in a week. Holy cow. Wouldn't you like to be long for that one? I know, I'd be really pretty pissed if I missed that, although I happen to actually be long Brazil this week, and I actually just sold it out today. I was long EWZ, and I'm out. I sold that position out today. I'll be looking to buy it back on a dip. So that is that. So let's cover a few individual stocks, and then maybe we'll, by the time we finish with those, we'll wrap up. So I gave you some SPY levels. If you're really curious about that and you want to see it graphically, be sure to tune into my video on Sunday. I will have a really hyper-accurate chart of SPY. I hate to say it's been flawless, but it really kind of has. For those of you who have been following me for a while, these levels have really, really worked, and I'll assume they'll keep working until they don't. So I will go over that on Sunday, and I don't say that in a braggadocious type of way. I say that as in it's worked, and let's do what works until it doesn't. So that's the deal with SPY. I said I think that there's potentially a little bit more room up. If, however, here's a scenario on SPY. If there's a gap down for some reason on Monday that takes out early, that takes out today's low, which was 99.03, I think there's a risk of it being a gap and go, meaning that it's a gap down that doesn't stop and it continues. So if you get that, you can try, I think, if you get a gap below today's low and the opening 15-minute range high, you can potentially use that as a right or right out type of a stop. Either opening 15 minutes or an hour range. It'll probably, my guess is that a gap like that initially would have a little bit of filling. It won't be like a straight free fall, but if you lose that opening range low, you could probably play it. I would let it rally a little if you can, and then either try and pick an area where you're comfortable, where you see a reversal point, or waiting for that low to be taken, and then you probably would get some follow-through. Probably in the later afternoon is my guess. It might chop a little bit, and then you'd get you'd probably have a little bit more down. It would be a bit of a stair step. You'd probably plateau for a little, and then you'd have like a late plunge is my thinking there. I always like to kind of pre-think these, because when you're in the heat of the moment, it's not always so easy if you haven't really anticipated this stuff. At least not for me. I mean, I guess I'm just not that good. I kind of have to think about it a little. I mean, I'm very good at noticing patterns and seeing things, but it wasn't always so. And even for me, I like to really be prepared ahead of time of thinking about try to think of like 2 or 3 scenarios about what could happen. Maybe none of them happen, but if one of them does happen, at least you're prepared for it. You know the levels and you know what to look for, and that's just how it is. One of the things that disturbed me today, let's do VIX first, and then I'll talk about what disturbed me today. I'm a little bit of a tease in that respect. I'm getting good at this, right, about teasing up videos. The VIX today got really close. We didn't quite get exact channel low touch, but the VIX is at the channel low, and the stochastics are pretty bombed out. I would not be looking to short too much premium down here. I'd be looking more to play directionally with long premium. I'll discuss that in the weekend video as well. But we are getting to the lower end of the VIX range. I'd be very, very cautious because of that. If there's particularly like some type of another spike move down, I think that could be a quote-unquote good low in the VIX for a little while. What disturbed me today? So I was looking through the types of stocks that were rallying, and it's a lot of energy and materials, a lot of these like beating the piss out of stocks that I think people had left for dead on the side of a road, like the Freeport McMorans, the Marathon Oils, these stocks that have been just killed and beat. I mean, think about like Steve Buscemi, wood chipper type of murdered. I mean, these things have been bludgeoned. So they had some pretty large rallies this week, and I think that a lot of that was probably a little bottom fishing and short covering and the like. I was thinking, I think that's the same thing with a couple of these other like beaten up stocks like the Hertz and the lumber liquidators and stuff like that. These stocks have just had some bounces. What disturbed me is the lack of participation in the kind of higher quality type of names. You have had some Apple participation, and I think a lot of that was it held the 92s. You got the 100, and I had tweeted out if you cleared the 100, you get the 103, and we got that. Basically, it closed on 103.01, so it's basically 103. If you can clear the 103s, we'll see, I believe, the 107s or 109s. Let me take a quick look at Apple here. Yeah, that's right. 107s would be the next real major resistance. There's a bit of a speed bump in the 105s, but yeah, 109. You could even see 109, believe it or not, or even a trend touch. We'll have to see. I don't want to get too ahead of ourselves in terms of this video. I will say this though. We did close below the key 103 levels, which are 103.12 to 103.74. So if you're long some Apple, it's probably a good idea that you wanted to have been taking a little bit of profits today at the 103. This 103 was also a really key level for the major run that got you really to the highs in Apple. The break over 103 is really where that rally got going. So it's a key level. Amazon was also a little weak. That's a really key stock that didn't participate today. It was actually red. Where's the other ones? Facebook was negative. That was a little stock specific because of some of their tax treatment in Europe. Although I always say the news always falls along the line of least resistance, and I had talked about selling some at the 110 level. So it doesn't surprise me that at some technical resistance, some bearish news came out. That's just sort of how the market works. Google was negative. That is a little alarming. These are big stocks that if you really want, particularly for the NASDAQ, if you have a big market rally, you want them to be participating. And I saw at one point Netflix was up a lot. Microsoft was weak. That's a really big one. Netflix, though, participated pretty well. I had talked about that a couple of days ago that I thought we would see the 100 level or maybe even the downtrend again, and it happened, actually. We're well over 100 today. We're at 101, and I think the high of the day was in the 102s. The bad news now is that you've gotten this big run basically off of $80, and you got over the 50, so that's bullish. But we stalled and closed right at the downtrend level. So there could be a little bit more up to the 103s, maybe 105s, but the risk reward here isn't as good as it was when I first talked about this trade in the 93s. So, this is again what I talk about, that balancing, the risk reward. Yeah, there's a little bit more upside here, but it might be a little bit late to first be jumping in. If you're first playing long in the 101s, 102s, just playing for 103 or 105, that risk isn't as good as it was like in the 93s. I mean, just the sheer amount of money you can make versus the downside isn't as good. So always think like that. I assure you, if you start thinking like that, you'll have much better returns and you'll have much fewer losses. Anyway, I want to cover someone asked me about Shake Shack. It's one that I'm kind of following. I kind of feel like there should be a little bit more of an up squeeze. We got that intraday, and then it kind of fell off pretty strongly toward the end of the day. I've been looking for that to get up to basically like 45. I think we got to 44 today. That was, 43.99. I'll keep it simple with you guys. As long as you're above this 41, I think the trade is long. They report next week, though, so any kind of up moves, I would be a little bit, particularly if they're ahead of earnings, there's a squeeze ahead of earnings you might want to lighten up into, but I would say anything really above 41 still keeps the up move in play. Anything that starts getting really back below 38 to me gets a little bit iffy, like 38.64 to be specific. Some people ask me, one thing to clear up, why I always say like 40s or 41s or 40. The reason is that often the market doesn't stop to the exact tick of that strike. You'll sometimes get a little push above or below. So I like the plural for that particular dollars range. So like 45s means anywhere from 45 to 45.99, basically. So somewhere in that range, if you can predict, I'll tell you, if you can predict the market to within, bottoms and tops within, a dollar's range or whatever, a few dollars range, you're doing a good job. So I'll leave it on that. If you wanted to rewatch this broadcast or came in late or what have you, it'll be up on my YouTube channel. That is Justin Pulitzer Trades. I highly suggest subscribing to the channel. You'll get notifications when I post the Periscope rebroadcasts, the special edition videos, and the much hyped here weekend review videos, which are usually basically 40 minutes, if I'm lucky, mostly closer between 40 minutes to an hour videos that I do each Sunday, sometimes Saturdays, but usually Sundays, that detail my more technical views on the market. Anyhow, let's have a good weekend, get rest, relaxed, refreshed. Check out the new, season of House of Cards. That's what I'm probably going to delve into in a little while. And I'll see you guys next week. Anyhow, I'll see you on Sunday, actually, and we'll go over some more of these trades. Anyhow, have a great weekend, and cheers.